Hello, welcome to the Shelly Show. I'm Shailendra and you watching this simulcast live on LinkedIn, Twitter, Facebook, and YouTube. I hope you and your family are safe and enjoying your life in time. For you to view this episode and other sessions that I run on emerging technologies, I would request you to follow me so you can be alerted when a live session is on. This gives you an opportunity to directly ask the question from our guests. So please press the follow button on LinkedIn and Twitter, and subscribe button on YouTube, and smash the bell icon so that you get alerted when a new show and a new session is on. For maximum reach of this episode, please like and share this episode on, of course, on YouTube and Twitter and LinkedIn, but on Facebook, please share it with various groups as well, which have AI focus and data science focus and analytics focus, so more and more people can learn from this episode. And also, please let me know if you're watching this live. If you're watching live, write live in the comment section. If you're watching this a replay, then write replay in the comment section. So let's have a quick run around. So today we're going to talk about credit risk. The ease with which consumers get access to credit scores, that easiness does not exist for SMEs. Consumers can purchase almost anything on their credit cards and easily obtain overdrafts, and they can do that because they've got a pay slip that can demonstrate their repayment capability. For typical customers, once they have the paperwork, it's a matter of minutes that they get approvals. But on the other side, SMEs, they live a very different reality that is frustrating and time consuming. Few suppliers accept credit cards, and lenders need to assess their credit risk by thoroughly analyzing the business, which is expensive and takes a lot of time. So overdrafts are very less common. This is the problem that many SMEs have: payment cycles that drain cash flow. Payment terms are often based on industry norms outside of their control or dictated by large market participants. This can jeopardize important supplier relationships, as well as potentially causing a domino effect further to their supply chain. This has been particularly problematic during the COVID-19 crisis as well. So to discuss all this, I will have with me today, of course, Marc Teerlink, who's always been there for our honor show for the last 9 shows. So welcome to the 9th episode of Artificial Intelligence Startup Series. In this series, we discuss about artificial intelligence and how startups actually are leading in this space. So today, again, we're joined by Marc Teerlink, who is the SAP's Global Vice President for Intelligent Enterprise Solutions and Artificial Intelligence. Marc is active in the startup community and as an angel investor, mentor, and board member. So without any further ado, let me get Marc to the show. Hi, Marc.
Hey, good morning. How are you guys doing?
How are you doing?
It's early here, I tell you. We left daylight saving time last week, and the disadvantage is that normally at this time of day I'm actually still having breakfast. So it's one of those days, you'll deal with it as you deal with it. It's anyway. The great thing is there's a lot of things positive happening, I find, also in our industry, around what you say, the whole credit risk discussion, and not so much in camera is playing funny today. Not only just in artificial intelligence that did its normal crunching and taking the tasks away from subject matter expert and analyst, but the models now are able to do things we couldn't do. We think about timeliness, think about dealing with the latency of getting the data, but also insight of the market. One of the things that I liked about our first episode that we did with NWI.ai is that we talked about how do companies take external data about trends, things that are happening outside you and I, and how do we bring it back in your company? So when you look to credit risk management, right, probability of default is whether it's a consumer or a company, a really important thing. So if you can cross-relate that to what is happening in this area, what is happening in this job sector, what's happening in that person, they talk about one of the areas in credit is or around risk management is about know your customer, KYC. And I don't know if you know this, Shelley, but I actually started my career in banking and mostly in merchant banking originally, and then I did the rotation. And I learned there are two emotions that drive the whole financial sector. Fear and greed. Fear and greed are the two things. And of course, risk management is all about managing the fear and optimizing the potential income. And in KYC models, right, but what you see a lot in know your customer models, there is this discussion going on, dealing, of course, with regulation and GDPR and privacy, etc. How do I not make the wrong decision? And that's not always about declining you, because risk models are geared to first and foremost reject you and to reduce risk to the maximum. But how do I not miss out an opportunity, right? The example is if you're in let's take Brooklyn, New York. If you're in Brooklyn, right, there is a lot of housing that has historical scores from people that rented there, the default, a lot of that. That historic score will skew a traditional model. When you go there, you say, hey, I have the opportunity to buy in this old dry dock complex this apartment, and you just get rejected because the zip code and the characteristic associating this building. But the last 5 years, some of the social dynamic profile of the renters has changed. Some apartment went from rent to sale, and a traditional model will just miss out. Well, a more AI-powered model says, okay, this is one of the inputs, the classic model, but there are some variations, like Shelley works at SAP. That's a solid employer. That is a solid employer. How they even in periods of letting go with an incredible, generous and humane approach. So in plain English, if you get sacked, there will be a severance package instead of thank you so much for your 23 years of service, right? Which gives me as a financial institute, yeah, you will have a few months while you find a new job to pay the rent or pay your mortgage. And the other part is not just in the timeliness, right? But it's I can see early warning signals earlier. So know your customer is not about just probability to default, but can I get early warning signals? Your industry, your behavior, your employer stock rate, all these kind of things. Now the challenge will always be the regulatory compliance, right? And it does make a big difference if you live in Hong Kong, Singapore, Amsterdam, or New York. But your governance and your data quality are still, I know I sound like a broken record, but your governance and your data quality, right, is still going to be the most essential to actually do AI-centric or AI-embedded credit management. So a lot of sexy things going on in the fintech sector. A lot of things. I look so much forward to have Flowcast and Kenzo here on the show to make all kind of serious conversation, but also some serious fun about credit management.
Okay, before we go there, I've got a question for one of our audience, Manish Gangwar. Manish, you've shown that you're angry. What's going on, mate? Were you not able to join us? What's going on? Can you please mention that in the comment section? And if you're not able to join us, then can you please get rid of that angry button and press the like button or the love button, whatever it is. Okay, coming back to Mark. But sorry, before getting to Mark, if you've got any question, please mention that question in the comment section, and I will take that question in the audience Q&A part. Definitely, if you've got a question, you will get it taken here. So please collect your questions. And also don't forget to press like and the follow button. Okay, coming back to Mark. Mark, do you see many startups in the financial services, AI and financial services space? What's going on there?
Well, fintech has always been around, right? Fintech is there are two industries that traditionally have been filled with data, especially with consumer data. This is the beginning of data warehouses, for instance, in the 80s and 90s already. And it is a financial industry and telecommunication. Especially in Western Europe, the Financial Services Act in the UK and similar action in the continental EU countries led to "thou shall know thy customer, thou shall deal with risk." Now, regulatory like Basel 2 and Basel 3, or Basel 2 and Basel 3, and solvency and insurance have also led to, am I doing regulatory for the sake of regulatory? Or am I actually gonna be smart and say, hey, if I have to be compliant anyway, let's go to the highest level of compliance where I can do customer profitability adjusted with risk. And now, what is your real potential? Not as what is your potential for your past, but your real potential, right? The pros, the cons, good, bad, and ugly. So having those pools of data and having those driving forces, external forces like regulatory, that people could see as an opportunity as compliance, has really driven the fintech sector in the last 3-4 years to grow up. And we see a lot of startups. I mean, an example is, right, our guest Flowcast got from ING, Serious Bank, right? From their innovation funds, seriously investment. It's a really good example how banks are doing. That same ING bank actually started together with the city of Amsterdam and the College of Applied Sciences and Economics in Amsterdam, what we call the new innovation district, Cumulus Park, right, where actually startups and VCs and companies are coming together. But they focuses on two things. One is identity management, the new ways, right? Do you really continuously need a bank card? Do you really need to continuously identify yourself? Or is your phone or your fingerprint, or like last week, Amazon released your hand enough to ID you? The other part, of course, that they go to data management, data insight for the sake of, you get it again, know your customer, risk management, credibility, all the typical kind of banking processes.
Yep.
So fintech by itself is an attractive market because there are gains to make, money to make. And the biggest bottleneck is if you cannot speak your customer's language. And with that, I mean your financial customers. So you can have the most beautiful solution in fintech that really does technical really, really well. But if you cannot go into that financial institution and you cannot relate to what actually for them is their industry, it's going to be a really, really, really hard sell. And I think that is something that has actually been the biggest bottleneck the last 2-3 years for incredible successful products that were not able to manage. So they're like 2 or 3 clients, high success, and they couldn't scale because they didn't know how to approach it. So let me summarize this again, right? So when I look to fintech, we talk about reduced and credit management, where AI plays. Reduce your time to credit decision, improve your customer experience, right? Both positive, right? Be faster, not just in your credit worthiness, but deal with default and default risk, and meet regulatory requirements. Because the great thing of AI-based models, it's much easier than traditional data science models to actually be compliant and offer service at the same time.
Okay, so let's talk particularly on credit risk for SMEs. So now, as I mentioned in my starting speech, it's very easy for individuals to get credit, and that's easy. What is being done, and looking at both the internal and the external data, what is being done for SMEs in this space? Because I think they really struggle if they're not getting their credit up there. If they don't have, they will have cash flow issues, and it's got a domino effect altogether. So how do you think machine learning can help in resolving that problem?
Well, wow, that's a really, so I'm definitely going to answer the question in a second. I think we need to realize that outside the United States, most credit systems have a higher level of sanity. And I really mean it not negatively, but The irony is that when the former president of the Fed or former President Obama retired from their job, they hadn't used their credit card decently in the last 4 or 8 years. And therefore, most financial investment decisions, right? I always have to think about the joke of Trevor Noah when he came, the comedian and the host of The Daily. Niels, when he came to the United States, he got an incredible great salary offer. His show was selling through the roof. He landed a contract with Netflix. And the only way to buy a car was cash because a credit model that looked better. But the second is you can have a top income, an incredible potential in US credit models, and it is ignored because the most important is thou shall first make debt and directly pay debt again. Now, you can actually have this amount of spending and this amount is outside the window even, right, of income. And then you have suddenly like, well, you have $100 more this month on your American Express. And then you lose like 10 credit points. And I'm like, seriously, like, but you can have $120,000 study loan, and if you every month just pay you nicely $50, you can have an 850-point credit score. Well, I have like your 4 year in business, and all you do is diligently pay the minimum amount for that loan. You have an incredible risk of exposure when you lose your job that you can't pay it and then you default it. But you have a better score than this person that has 6 times your income, that hardly uses a credit card, loyally pays it every month, right? And then suddenly has $100 more than the average amount on its account. And that's where that model is broken. So if you can fix that for the credit assessment, but also for SMEs in the US, you already changed the ballgame. Let's be clear, right? The best would be if the credit industry actually would lobby for a better insightful forward way. But this is the single best way. Now, if you're out of the US, where you actually have a much more forward-looking credit risk system, so how much have you saved? How much do you earn? What is your potential? What is your age? Or what is your industry? And you go in that, you actually see it gets much more interesting because now we're talking about balancing and taking the extra risk, right? The same applies, for instance, in mortgage, which is another kind of credit, right? But assessment, where banks the last years have taken the risk for the resellability of the object. So in cities with a high demand, Amsterdam, Paris, London, etc., New York, the last 6-7 months, some of those cities, those numbers have changed. Like Amsterdam, it's not easy to get more houses. The demand was bigger, so the housing market is pretty stable. Take New York, take Manhattan, etc., right? The bulk of our colleagues, Shelley, who lived in Manhattan that actually had a cabin or whatever outside the city are there now. They're there for months. I'm not going to do dramatic like it looks like a ghost town or whatever, but there are streets that are pretty low in being inhabited at the moment in New York, in Brooklyn, right, and already in Hoboken. So if you want to rent a house at the moment in New York, it's a renter's market. It's not an right, or it's a buyer's market. It always used to be a seller's market in New York. So that tells you that something in 6 months, something's changed so much. So the risk of the object and the risk of the individual are now 2 components that traditional models didn't take that way in account. So we live in interesting times here, Shelley.
Okay, so how does machine learning or artificial intelligence, it assesses good and bad credit, and which can help to tweak the loans for the SMEs. So how does it actually work? Is it only the external factors or external data? It looks internal data, brings it all together. How does that work?
Well, so let's go back to the definition of AI, right? AI is not one thing. AI is multiple things.
Yeah.
And what we see is that AI orchestrates a bunch of technologies together. That's also where intelligent or AI-driven robotic process automation comes in. And maybe 20% of that is machine learning. So you take the output of data science, you feed it in machine learning, take the output of business intelligence, feed it in machine learning, take the output of big data, feed it in machine learning. You'll combine it, for instance, with a chatbot or for an interactive dashboard. And slowly you offload one task of a professional. Now, maybe you can automate that task for 80% so that professional can focus on the outliers, the negative and positive, like, yeah, this is too hard for me, says the model, right? But models in especially financial management and risk management are not new. The point is they were mostly rule-based. And therefore, the amount of outliers and the amount of complaints and the amount of efforts around it were painful. So either customers got, excuse my French, screwed over, right? Or processes were very frustrating for people that knew that the process shouldn't do that. The good thing of machine learning is because it adapts continuously by the data you feed and the best expert in a company that train and correct it, right? You can actually much faster create a sustainable agility, resilience in your model and your business approach than you could do before. So the role as AI to slowly take over the inflexible and less dynamic components, right, is really in this part of fintech, and in part, I can be more timely, I can be more flexible, but most important, I can create a better agility and create a renewed resilience in crises like these. But it also means that your governance around it, your training, your new data, adopting your model, testing it, is part of your engine as a company.
Have I lost you, Mark?
I'm here. Can you hear me?
Oh, yes, we can hear you. Okay.
Yeah, my image is still frozen again. I have no clue what's happening.
That doesn't matter. Keep going.
I think my internet connection is not awake yet this morning. That's probably the story in short. It's always the most how would you call it, elegant moment. Your face is frozen, right?
No, it's good.
So, but no, that's in short. I think where a lot of the issues are, Shelley, at the moment in the market.
Okay, guys, one such startup that works on credit risk for SMEs is Flowcast. So let's not waste any time. And let me talk about Flowcast first. Flowcast is a VC-backed startup helping funders automate and make smarter credit decisions. Its AI solution helps to automate risk assessment for SMEs, finance, which otherwise is a manual and a costly process, as we all know, because it takes a lot of time and a lot of people involved to do that. Their existing clients are large financial institutions and corporations such as Standard Chartered Bank and ING and Nike and whatnot. The enterprise solution is a machine learning solution to enhance credit decisions. Its explainable algorithm uses financial, transactional, and alternative data, which Mark just talked about, to enhance accuracy. Today, we have with us Ken So, who is the founder and CEO of Flowcast. Prior to founding Flowcast, Ken has over 20 years of experience in business development, merger and acquisitions, and engineering. He closed over $4 billion in merger acquisition deals and strategic partnerships as a corporate development executive at companies like Qualcomm, Ericsson, and Citibank. He started his career as an engineer and holds over 13 patents, so pretty well known in the industry. He received his MBA from UC Berkeley, Master's in Electrical Engineering from University of Illinois, Urbana-Champaign, and business Bachelor of Science in Electrical Engineering from University of Waterloo. So without any further ado, let me get Ken to the show. Hi, Ken. Welcome to the Artificial Intelligence Startup Insight series. How are you doing today?
I'm doing well. Thanks for having me.
Good stuff.
Great to hear.
Okay, tell us about Flowcast in your own words, without me blabbering about it and trying to explain. Well, you are the best person to explain that.
Yeah, I mean, you guys highlighted quite a few of the pain points that we saw. I mean, the genesis of Flowcast really kind of started recognizing there was a big need in SME credit. I grew up in a family of small businesses and saw that it was tough for businesses to get access to capital. And when I started Flowcast, we wanted to do something very differently. So I look for moments of innovations, and the right one was looking at this intersection between finance and AI. And this is around the time when big data and data lakes, Hadoop was taking off. So the access to that data was becoming much more readily available. So we set off to do that, and we did it differently by focusing more on the larger financial institutions, and we got fortunately got access to lots of companies' help and created the first product. It was at the time, building a startup from scratch. Obviously, every entrepreneur and founder can share their story, and going down on Sand Hill Road and trying, speaking with ADVCs and hoping to get, you hear so many no's and hoping to get one yes and to get that first check, and once you have a little bit of money, then you just kind of crank along and start trying to build that journey from there on. And selling into big banks was wasn't easy. Very long sales cycle, but eventually, if you build something great, something compelling, then there's going to be some traction down the road. So maybe I'll pause here and see if you have other questions.
Good stuff. So tell us about you articulated the journey. So what were the challenges being a startup? Was it more not having the funds, or was it talking to the banks? What were the challenges you sought through the entire journey of yours, from where you started to where you are at today?
Yeah. I mean, I think there's no straight line from starting point to success. There's always lots of ups and downs. But that's kind of the beauty of being an entrepreneur, right? It does kind of change you as an entrepreneur. And I mean, the learnings that I got the past 4 years, it's much more so than the past 15 years, prior to this. So it may sound a bit intuitive, but the whole idea of entrepreneurship is not based on what can go wrong, but what can go right. And it's something that does go right, that can become very big, and that's really kind of what we have to kind of persevere on and strive for, and you have to kind of enjoy that process. It's not just about the end game; it's really about the process, and just getting punched in the face or eating last, and you just don't stop working. That's kind of the joy of being an entrepreneur, is both the thrill of getting potential output, but also the fear of losing, right? Losing on best people that are on your team, or losing key customers. And we have experienced many of those things. But that's kind of how I see things and kind of persevere through the journey.
So explain to us, how does your solution actually calculate the credit risk? What all things does it look at? Internal data, external data, any segments? How do you work on creating credit risk for SMEs? And I'll tell you why I'm asking that. Long time ago, I used to create credit scores for individuals, and that was because I had a 10 million large database, and we had to offer them credit card, but that was at individual level. So, and it's and as you know, it's so expensive to go to a bureau and ask them for a credit score for someone you're not even sure whether you're going to offer them a credit card. So we wanted to do something internally. How do you do that for SMEs where the information is not that much available? How do you work around that?
Yeah. It's important to kind of set the context. So, you look at worldwide, there's over $3 trillion sort of credit gap for SMEs. And, 3 out of 4 small businesses, gets rejected from applying for a loan at a big bank, while, about a third of those are actually fundable. And mainly is due to what you just highlighted, because they're thin file clients, there's lack of access to good information and financials. So a lot of them just don't have that ability. So what do banks do, right? You ask to assess that credit is primarily looking at very traditional metrics, whether it's their historical audit their unaudited financials or their tax statement, and then more static type data to determine their level of risk. But that's not going to cut it in, particularly in an environment that we're in today, where things change on a dime. There's a lot of government stimulus. There's a lot of deferment programs that are kind of masking the underlying fundamentals of the business. And so where do we tap into that data? And what's sort of changed now versus, say, 5 or 10 years ago is that data of small businesses that are becoming more and more readily available. From open banking in Europe to having kind of bank connectors around, in the US, you got more than 5,000 banks and credit unions, having connectors to all those type of banks to get both real time and also historical transaction data from the bank statement to the QuickBook, accounting type software type data. That's becoming much more readily available in the past several years than 5-10 years ago. And if you can apply intelligence on top of that, then you can build pretty compelling models that you couldn't have done a while back, or you could have done it, but it'd be very difficult to do it in prior times when people accounting software was still sitting on their desktop or still on a server or uploading PDFs in the past. It's kind of no longer the case now. So you got the more real-time transaction data that's more readily available that can help build a more real-time model. The second is if you look at some of the non-fintechs out there, whether it's the Amazon, the Square where they got POS type data, or a Shopify, they have much more of an end-to-end life cycle of their customer from a search to the intent of buying to actually purchasing the good. And so they have much more information than anybody else. They're in the prime position in providing credit to these both individuals and also merchants and small businesses. And having access to that proprietary data is really their competitive advantage. And now you're seeing payroll providers like Gusto and also kind of offering payday loans and so forth. It's just, I think, that's kind of the trend, is this whole rebundling of financial services with some of these non-tech players, because now they're sitting on this gold mine of data that, traditional financial institutions just don't have.
Mm-hmm. Okay. So at the moment, we've got more than 30 people watching this episode. Guys, if you've got a question, please put that in the comment section and I will take that question to both Ken and Mark. If you've got a question related to credit score or credit risk, furthermore, please put that question in the comment section, and also don't forget to like, share this episode so more and more people can learn from this episode. Ken, I've got a question for you around COVID. So now, as things have changed during the COVID-19 times, how have you seen it difficult to calculate the same credit score which you would have created earlier before COVID-19 arrived? What is the change that has happened?
Yeah, absolutely. I think when COVID really kind of hit, early in the year, a lot of banks and institutions were reaching out to us saying, a lot of their existing models are either obsolete or cannot be trusted or needs to be fully kind of revalidated because of all the underlying issues that we talked about. What can we do to have access to a model where it's much more predictive of what's going to happen in the future, in a post-COVID environment, if that model was trained on data that was pre-COVID. So that was kind of the big dilemma, and that leads to the whole notion of early warning signal. Can we build a compelling early warning signal to help financial institutions and help lenders be able to stay on top of the portfolio, either to prevent incident or collection, or prevent or go out and proactively offer new products and solutions to their clients? And that was kind of what we set up to do. And I think this leads to the whole notion of what we call causal intelligence. Yep. Meaning, so AI is always kind of, or machine learning in general, is more about kind of looking at training on data, historical data, and taking on much more of an empirical type approach. With Causal Intelligence, you're seeking something somewhat much more logical. What if A happens? What happens to B? And if you can establish that relationship, you can actually infer and be able to make much more predictive type projection on both on your portfolio and also kind of the customers that you want to deal with. So we've started to introduce some of those methodologies into our solution stack, and now running POCs and pilots with some of our lenders and and our financial institution type clients to ensure that we have the early warning signal that can be predictive and high performant, but also kind of future proof for a post-COVID type environment.
So one question which comes to my mind, being a part statistician, does the kind of techniques that you used pre-COVID change to what are being used now? Is that, maybe you were using decision trees or neural beforehand and now you're using something else, or is that just the modification because data is changing as well, and you're creating some early warning systems, but you need to understand how data is less, or because the data becomes too less when you're trying to just model COVID.
Correct. Yeah, so it's a combination of both. So we still continue to use, now that we have 6 months or 8 months of COVID type data, so we have a little bit more learning than before, back in March or April timeframe. So we do try to test against more recent data than say pre-March or February type timeframe. Moreover, we are introducing some of these new concepts to introduce like prior into the model to have much more of a kind of a performant type accuracy. When we start to kind of predict some of these outlier cases, as it pertains to defaults or pertains to kind of incident or collection type use cases.
Okay, Ken. Before I ask the next question, can you please stay in the middle of the screen? You're just on the right.
Sorry. Yeah.
Yes. Anyways, tell us about Tilful. What is the difference between Flowcast and Tilful? Can you just throw some light? I think it was in the news recently.
Yeah, so we recently launched a new product called Tilful, which is a free business credit platform for the US market. And it's really directly for the small business owners to give them a fair and transparent access to their credit. So if you look at kind of what's the backdrop is, you got kind of the three business credit reporting agency in the US, DNB, Experian, Equifax, and those three are based on more static and traditional data, primarily using trait lines and so forth. Trait line takes a long time to establish. It takes months, if not years, to establish. And a lot of small businesses are, they need to know what the standing is. They need to kind of start to build up their own credit, derive some better financial health. So that's what we launched in the past 3 months to help business owners understand what is their credit profile, and you get a free business credit score. And in turn, we would use our understanding of their profile to match them with loan offers. Mm-hmm. So those that are qualified for certain loans, they have a high degree of getting an approval versus others. So that allows them to get much closer access to capital that they need. Also, kind of saves a lot of time and money and in getting the actual loan offers that they need or credit offers that they need. So it's been traction has been really good past several months. We're getting strong interest both on the business owner side and also on the lender side. So we're rolling out new features over the next month or two to really delight clients and customers on this offering. And so I think this is one of the kind of more game-changing type solutions that I think we need in this environment. especially when we do see, banks are starting to tighten their credit, and also a lot of the peer-to-peer lenders have kind of stopped lending directly to SMEs.
Okay, Mark, what do you think about Flowcast? Your point of view.
I think this concept is phenomenal. I mean, Ken, you heard already my joy and my personal opinion on the current U.S., especially for consumers, credit system. And we've seen in the consumer market with, for instance, with consumer products like Credit Karma doing the similar approach, like the matching part, like, hey, these are some cards where you very likely successfully, should you apply, get this card. Or these are some products that even if you hardly use them, if you just enroll them, you would boost up your credit score, right? Because the other thing is, I can also help my customers rig their system to actually show, and I don't mean rig negatively, to show what their real potential is. So I think what Flowcast is doing is absolutely filling in an important need for small, medium-sized enterprises, for businesses with less than 2 years of history. Now, the causality is really the most important, that Ken said. We discussed this when we had NWO over. There's a company I have on a regular basis some really fun conversation with Causality Link, and let's bring in what they do. So this also for the outside people, that causality is what companies like Causality Link or NWO, for instance, do, is they go to all the words, like the transcripts from financial institutions. Of course, those have to be stock listed or at least public enough to have to do some investors' public statements. But you can't lie your as a CFO. You can just not highlight points or make them less important, but you can't lie. And otherwise you end up in jail. And the CFOs don't want that. So taking that and taking other statements that happen in the market is what they call the wisdom of the crowd, and not like the crowd all, but it's actually the sum of all the interactions and trends that we are creating in emotions. And Andrew Lowe from MIT had a few months ago a phenomenal economic impact story about COVID, because COVID is not a normal economic crisis. It's a crisis of fear. A financial crisis, like we had in 2008, the Lehman Brothers situation, etc., was really a financial falling down of a financial system. But now the fact that you get mock mass going for toilet rolls, well, there is probably more stack in the US to Armageddon of toilet rolls. Still, that madness of those crowds, that irrationality, is disturbing any financial system and any financial classic model. So the more you are able, as Ken is pointing out, to build causality coming back in your model, whether you use emotions, transcript, but some kind of wisdom of the crowd, or maybe the non-wisdom, and you say, let's alter my model and let's give this to players that, but you're an outlier, you're actually not negatively affected. Like, if the famous example, if you were a company that made plexiglass windows, right, you should have gotten a loan because you were supplying every CVS, Walgreens, pharmacist in the US with these plexiglass windows at the checkout and at the prescription desk. And those companies were struggling. They were struggling to get some extra financing to beef up their production, right? So the irony, if you look to the impact of COVID, some measures that small companies could have taken were literally restricted by the inflexibility of the current system. And what I hear Ken saying is like, well, can we add flexibility back to it?
Mm-hmm. Yeah, that's a good way of putting it. That's right.
I try to listen to your smart remarks, I mean smart, smart, really positive. Like, I just want to say for our viewers, right? Ken has articulated in a few sentences so much of the essence around the whole financial credit market in the US. And kudos to how you just summarize this and what your company is doing, because sadly, I don't hear that daily. And so I think you guys are doing a really, really good job. Now, I'm going to come with my question to you. How are you going to scale this? Because you have a limited amount of people, right? What is your strategy to scale up Flowcast offerings and bring this further to market?
Yeah, definitely. On the TOEFL side, we have a couple of go-to-market strategy. One is the traditional organic path, which is doing a fair amount of marketing SEO. But the other one is through channel partnerships. For example, we are actually partnered with SAP.io. We're part of the program last year in Asia, and so that's kind of helped us get into a lot more doors than without it. We also partner with ING, obviously, so they are both an investor and also a strategic partner for us, and that also kind of helps us with some of the channels in Europe. And then currently we're working on a couple other kind of channel partnerships where they do already have an access to a lot of the SME on their marketplace and platform, which also allow us to get access to more data and so forth. So there are a couple of ways we're trying to scale this. On the lender side, I think we're doing quite well in terms of onboarding lenders. And so we have pretty good set of offering now, both on the, from line of credit, small business loans, business credit cards, to working capital loans. So we're kind of adding a few more specialty ones. But yeah, I think that part we're okay. Now we're just kind of, go out to a lot of the small business owners.
So thank you. There's two things I didn't hear in your strategy, and I just wonder, is that because you don't want to talk about it? Is that because you don't see it as a rapid go-to-market in your partnerships? Because you earlier mentioned the traditional, or not traditional, but the software, the accountant software that the small, medium-sized business use, right? The classic, like the QuickBooks, the newcomers like Xero, etc. And for those viewing, right, when you want to be a one-person start business or you're a 5-person start business, in the old days, you had to make your invoice yourself, and right, this kind of software for $10 a month allows you to do literally everything. You keep your hours, you generate an invoice, you read out your bank account income, and you bring it back to your ledger. You'll connect it actually to your analysis. You make it available to your accountant. So the next logical step, I would say, is, well, can I directly see my credit score coming back in? Can we actually make a what if, like, this is my projection, what would that mean for my score? Is there other things that I should do? Sometimes the question for a small, medium-sized business isn't that logical. Everybody wants to get that invoice paid directly.
Yeah.
But maybe having it paid one day later, which is the next quarter, might actually be better for your score. Maybe having an install payment with a client, letting them pay in 5 terms, instead of 60 days, everything at once, is actually better for your exposure. So how are you looking forward to teaming up with this typical kind of accounting software plus that small businesses are using?
Yeah, no, that you're right. So that is actually part of our strategy. So kind of the phase 2 of Tilfo, it is bringing this credit score as a service to platform players, not just QuickBooks of the world, but also, you got Salesforce, you got quite a few other ecosystem that we can kind of tap into, whether Stripe or Spotify or Shopify, I meant. So they do have like these app stores and a marketplace where other small business owners and e-commerce merchants can tap into, and figuring out what scores that whether it's customers or vendors that they're dealing with, and they can grant payment terms, extend terms based on that type of insight. So and it doesn't preclude just the small guys. The big corporates can also leverage a lot of this. Instead of paying D&B or others, a lot of money to buy that score, there's other ways of accessing more real-time type data.
Right.
So, yeah.
Well, I mean, it's really good you mentioned it, because a lot of like D&B and other players, although it's called credit score, it's more for enterprises, a solvability score, for the better word, right? If I'm going to do business with this company and I make cars, this is going to be one of my new 12 lock suppliers.
Yeah.
Going to be afloat in 6 months from now? That's actually the question that I have from a supply chain point of view, right? Are they going to be able to finance their suppliers? Are they going to be able 6 months from now still to handle that? And especially when the unexpected, like a COVID, comes up, right? These are important questions that merchandisers have in supply chain. Now, the other thing that I see much more is the assessment of enterprises for small, medium-sized businesses, which goes beyond the ranking of the LLC, for the better word. It goes to the ranking of the founder, owner, senior management. I'm going to take a really painful example here. When Kickstarter and Indiegogo started a few years ago with all these sexy tech stuff, and we nerds knew in the back of our heart that we were investing and not pre-ordering. It was called pre-order, but we were investing in a concept what we prayed and hoped it would come. Now, sadly, companies like Kickstarter and Indiegogo never do any credit score, never do any vetting. They say, hey, this is great, and this company is, and we'll just hope. And in the beginning, they did a great job, and then they became successful. And now you and I sit there and like, oh, wow, this is really a great concept. So what happened recently, if you are a sci-fi nerd, and you're like, wow, there's this company, and it comes with a HAL 9000 replica. And look, they have the licenses from Warner Bros., etc., and these companies already sells replicas. This must be solid gold. Let's pony up $1,000 of it. Basically, around 600,000 or 6 million, I don't have the number at hand, of people ponying money in it. And suddenly, oopsie dozy, we have shown in all kind of events, and the sun, the moon, the stars are, by the way, covered as well. Chapter 7, and by the way, before you start knocking on the door, Chapter 11. But then you cross-relate, and you actually see that the founder, twice with similar companies, had done a Chapter 7, 11 route and cashed in those pre-orders investments. And that's the credit risk that we now are looking for, that when we start investing in smaller companies, or when we start pre-ordering, buying product, etc., right, in these times, that the company might look solvable and the company might look solid, right?
Yeah.
But the history of some of the core executive founders in it isn't taking consideration. And of course, what you now get as a critique to the Kickstarters and Indiegogo of the world, and also to other of these kind of crowdsourcers already. So like, you're doing crowdsourcing, but you're doing a really, really crappy job in actually vetting company. And no, we looked at the credit score of the company. No. That's not enough. They shall have to look further. And that's where we're going to go. And I see this in the automotive industry as well, where the BMWs and the Mercedeses and the Volkswagens of this world used to only check, like, is this a very solid, not too far from my German plant supplier? And now there's like, are these actually very solid executives in this company? Now, my personal credit score shouldn't be involved in SAP's part, right? But if the bulk of SAP senior managers and executives are in shaky things, it will change our behavior. Now, luckily we're not, but it will change the behavior. So but there's also the cost of privacy at the same time, right?
Yeah.
So there's this balance between privacy of the executive and the industry behavior they have displayed. And the company is still the sum of its executive at this moment and its customers. Yeah. So how do you see where this is going? Like these kind of trends that people demand that the credit window looks at bigger pictures than just the company's behavior as such?
Yeah, I mean, it is a very good question, and it has to do with ethics. It has to do with with the whole Fair Credit Lending Act, and particularly in the U.S., where you can't use any kind of discriminatory type factors, which means if you were to try to do that, use AI, machine learning, inherently you're gonna creep it. Some of that is gonna creep into your model. So if we start to use that for the small business side and leverage that type of data, personal type information data, in incorporating the models, then you do run the risk of fairness in your model. That said, we do see quite a lot of signals, especially for businesses that are kind of less than 2 million revenue. That personal credit is a huge factor to the business credit for sure. And then one interesting sort of signal that we found was the further you are the business owner's home address to the office address, the further you are, the higher the chance of a credit risk for the business. So it does have a strong kind of impact on, the personal credit has a strong impact on the business assessment. And I think the good news is, you don't need an SME, you don't need a business license or a license in general to do small business loans in the US. And all this is, factoring, FCA, all those is completely unregulated. SBA, on the other hand, is of, it's government backed, so there's more scrutiny on that side. But I think there's, it's really because of the lack of data where you don't see more interesting models. But I think that's really starting to change quite a bit. And I think Europe as well. Europe, certain countries have very robust data, both publicly and also through open banking. That also kind of allows much more deeper insight on the small businesses. But I think for sure, we do see the business owner, the board director, those factors, some of those we do take into account in the model.
So thank you for that. I want to, for 10 seconds, go deeper on that. So I see, let's go to gender.
Yeah.
So what I've seen the last 2-3 years is that where Northwestern European financial institutions actually have positively, favorably looked into women-led company, women-founded company, etc. Let's be clear. You always look to the acumen of the quality of the individual, independent of gender, race, etc., etc. However, we see, when we look at the credit numbers, we see actually that in small, medium-sized businesses, that in Northwestern Europe, it turned out that the last 10 years, female-led businesses, female-led entrepreneurs, right, have done much better and low risk-taking and low credit exposure than traditional male-led companies. So what we have seen is that credit officers and lending officers have been actually doing what you call the manual intervention, right? Very nice outcome of this model. However, these people are more solid than you say, right? We also have seen in other parts of the world the opposite, right? When this is where microfinancing sometimes has to compensate for the failure of a normal financial system, where actually female entrepreneurs hardly get any chance, like, oh, you're a little lady starting with your business. No, we don't do this. Sorry, come back when your daddy gives you money. I mean, let's just be really, I see your grin, but I mean, these things happen, right? It's so this is a painful topic, right? We have been the last months overwhelmed with algorithms of oppression. The internet is racistic, fake news, all these kind of questioning the ethical part of data scientists, and there's a bunch in your company, Ken, right? The ethical part of what we do as data scientists in being as fair as possible in our models. And now, of course, the discussion following Me Too, following the whole discussion about that people of color, people of female gender or LGBT are discriminated in models, and therefore also in credit models, is coming up. So, you know where this is going. How do you see this?
Yeah. Short answer, I don't have a solution. but I do see the trends are, it doesn't make sense to me. Like, same thing that's happening in the VC world, where female-led startups tend to not get the funding that they need. Yet, if you look at the actual data, they are the ones actually the most successful. Even the publicly traded ones. If you look at all the top, if you put an index on publicly traded companies that are led by CEOs, they actually outperform, the S&P 500. And so there's this whole kind of disconnect between why they're not getting the funding that they need. Same with the minority groups as well, other minority groups as well. And there's part of it could be more social type issues. But from a machine learning data science perspective, certainly those are features that we have to stay away from, and we have to eliminate any sort of bias against or discriminatory type factors. There are, even the indirect ones that, whether zip code related or whatnot, we do need to pay special care, care attention to that to ensure our models is, are ethical and does not have the biases. And there are guidelines that are in place both in Europe and in places like Singapore with FEED. They help, model building and ensure that these things don't creep up. I think that a lot. If you look at all the models in totality that are out there today, a lot of them probably do include a lot of these biases. But if you don't have the same kind of level of scrutiny as like an Amazon or a Google, Amazon with the whole AI recruiting tool, showing biases towards gender or Apple with a credit card. There are also a lot of models that are staying under the radar. But I think the trend is that there are these tools that will help model building, help data scientists to service these issues, and also be able to audit properly and be able to validate properly. I think that's sort of the next step, and having kind of the right guidelines and framework, and in order for AI companies to be able to adhere to these concerns.
So sorry.
One question I have for you. Sorry, go on, Mark.
No, I just want to thank Ken, because that was a really well balanced, eloquent answer, and I think this is the kind of thinking where we need to go in an industry. There's no answer but to continuously go to the balancing act, as Ken says. I do want to add one funny remark though before we go back to you, Shelley. Remember when Christine Lagarde took over the IMF, and she made that brilliant statement like, "It takes a strong woman to clean up a man's mess."
One question, not a question, just a thought. We're talking about scaling up. Have you thought about creating an API for likes of MYOB and QuickBooks so that they can just access your environment? And this will give you a two-way environment. You can get their data in real time. You don't need it in real time, but you can get access to their data and they can access on real-time credit scoring, something like that. Have you thought about that?
Yeah, so we're actually looking at several platforms. It's kind of like the plat for accounting data software or accounting software type tool to allow us to ingest accounting software type data, not just from QuickBooks, but all the other ones like Xero and FreshBooks and so forth. So that's something we're kind of on the roadmap that we're working on. We're actually offering an API to both lenders and other platforms, so they can actually consume the score immediately and be able to run their early warning signal through us. So that's available for lenders and other financial institutions. But accounting software data is kind of the next logical step. Now, we're currently consuming bank transaction data, which kind of is already 80% of the way and 90% of the way, because it is the source of truth for a business. So that captures already a lot of the information that we need, outside of accounting software, outside the GL. Okay.
Before I come back to my next comment or question, guys, this is your opportunity to ask questions to Mark and Ken from Flowcast. If you've got a question, put that in the comment section, and I'll take that very, very soon, because we're going to get into the audience Q&A. And also, if you're watching this on Facebook, please like and share this episode with other groups which are AI related or data science or big data related groups or financial services related groups, so that more and more people can learn from this. If you're watching this on LinkedIn, then please like this, press the follow button so that you get alerted. And also don't forget to ask your question in the comment section. If you're watching this on YouTube, please press the subscribe button and smash the bell icon. Coming back to you now, Ken. We've asked you enough questions. Any question you have for us?
I'll be curious from SAP standpoint, given COVID, I know there's obviously a lot of probably changes, but what's sort of the one key strategic change that you see is kind of the most impactful for SAP?
Yeah, can I take that, Shelley?
Yeah, go on.
Okay. So a lot of SAP's clients are traditional. If you look at the typical McKinsey stack of how fast will they embrace digital change, not at the top part of that chart.
Yep.
And that meant that somewhere in the early 2000s, they went to a version of SAP and they took their forms that they had in 1995, said, let's take that form and one-on-one put that in an SAP system. And of course, in those days, consultant made oodles of money by saying, oh, let me hack and smack and customize your system because yours is so unique like everybody else. The real story is, of course, you should actually take standardized processes as much as you can because it's easier to build an ecosystem to exchange with your suppliers, exchange with your customers, standardize on data, and focus much more on the secret sauce of what you do, that you customize its unique part, and look at your data, your insight, and your reporting, because that's really where your gold is. Now, companies have heard that, but only a few in the upper right hand of the Gartner quadrant also acted on it, and the rest, whatever. So when in March this year we had to totally kill 900 marketing events in SAP and go to a digital event part, I had some hard words with our SAP marketing people that were super excited to do all these product pitches. And I'm like, there's no CFO that's going to look for 8 hours at a product dev by PowerPoint Zoom call. It's not going to work. I mean, the reality where people go to events is that moment that you and I can walk out of a room, we stand in line for coffee, say, what did you really think of that? Or we meet each other in the airport and I'll see you still wear the lanyard from the event and say, hey, you were there. So how was it for you? That's the real value of these things. So we turned it around and we started with 45 or 90 minutes. CXO only, do not send a proxy that is not on your level, send a peer, but not somebody less, and make this an open peer discussion where you take things outside with you. And the first question in the polling, so we do like 3-4 minutes case polling, breakouts, etc., is what has changed? Never waste a good crisis, right? What has changed your company? What has been driving digital transformation? 1, the CEO. 2, the CFO. 3, the chief risk officer. 4, the CTO. 5, COVID-19. And overwhelming, the winner in this poll was COVID-19. So all these people that, this expression, denial is not only a river in Egypt. All these companies that were pushing their digital transformation forward, I don't need to go to cloud. It's resilient enough. I can run this from my data center. Suddenly find out, like, hold on, these people in my data center are ill. If it was an SAP cloud, it would be SAP's problem and not mine. And all these companies were like, I have automatic replenishment mechanisms, but it doesn't work with COVID because my systems keeps ordering toilet rolls instead of figuring out and giving the flexibility to those franchisers or to those stores to actually locally source what the supply chain can't be doing. Or I'm still ordering like a madman all these components, but my supply chain and my forecasts have significantly changed and my models can't anticipate on it. So what we saw was an almost inertia in all their models, in all their infrastructure, and lack of agility in that. And then we've seen two kind of behaviors. And I'll be fair, if you looked at the stock market yesterday, you'll see the impact directly.
Yeah.
We saw, one, those that were actually on cloud and started to beef up and insert our later AI-based components, our intelligent technology package, or upgraded rapidly, which was great for us in Q1 and Q2. But then in Q3, even if they had become more agile, they still suffered from the market and they had less transactions. That hits you when it's any company, because I can't talk about SAP, but any company that has a consumption-based model, of course, gets hit when the consumption gets down, right? Then you saw the other part of company that basically said, well, we have everything on-prem. Upgrading on-prem is not going to solve it. We now need to be more flexible and get this agility in it and figure out how to hack and smack. So we've seen two kind of CIOs and CTOs totally being either I have top technology, but my business model can't deal with it, or I might have an agility business model, but my technology can't deal with it. And in both, we are SAP at that moment trying to figure out how to sit with this customer, how in a digital part go to this customer, how to prioritize, because suddenly your meetings are on Zoom.
Mm-hmm.
And that you would think that gives you more time, but every meeting needs to prepare. Every meeting needs to be about the right people in the room. And that turns out not to be as easy over Zoom as it was when we really had a dedicated joint agenda, right? I mean, and then you sit there with an executive on Zoom, and then his or her kid walk in, their dog start barking, the camera start freezing. Not these things you have when you have coffee in the boardroom. So how is this impacting SAP? It is both a challenge and an opportunity. The challenge is for us to support those customers that are struggling. The challenge is anticipating on change consumption models and companies that for liquidity reasons postpone further upgrading. An opportunity is to be there for those customers that thought, I just do a one-off improvisation, and when this COVID is over in 6 months, I'll just go back to business as usual, that are now being hit, that they don't have enough flexibility in their system, their business system anymore, to do a second improvisation anymore, because everything is tight and narrow and people are worn out. And then they come back to us and say, so what can you do? And like, well, 6 months ago, I knew what to do, but man, you put yourself to the wall, and now I'm right. So these are balancing acts. And of course, for this, there is no risk model. So this is where executive judgment call comes in. If Shelley can visit only one customer and spend their 3 days with, whom is that customer going to be? Right? Who are we going to get our best people to help and through this? And these are also for us rediscovering our core skills, etc. It also meant that we had to, where we were incredibly proud on the last 2-3 years of decentralizing and giving teams a lot of leeway, etc., that our need to coordinate these things are totally different. So I think for our industry, like every service industry and software industry, things have changed. The point is, though, that some of our clients must be on-prem, because if you're a manufacturing plant, you need to have at least some edge computing to deal with the leniency and those kind of things, and connect it to a cloud. But then you need to be able to have somebody to walk in your factory and actually, in those narrow spaces, install that stuff with 2 people that need to be 6 foot apart.
Yeah.
And so these are some serious challenges that are there. Now, back to your industry, especially when it's about financial services or financial insights, yeah, those are doing good. Those are doing good. Those are, as I say, greed and fear. They are both great emotions to run a financial business on. And what you see, especially insurance business, is doing well. Employment insurances, health insurances, they're selling like hot tickets at the World Series. That's.
Any other question for you for us, Ken?
No, we can go to the audience.
Questions? Okay, guys, this is your chance to ask questions, and I'm going to run through the audience questions very, very quickly. Okay, let's start. Let's start from the start. First comment from Poonam Sood. She's a regular on the show. Hi, Poonam. How are you? Like always. Manish Gangwar, I think he was not happy with something. He still isn't happy with that. But I think he said, please allow. I think he was not able to join in or something. Anyways, that's fine. Manish, I tried. It may be the network. I can blame it on the network. Okay. Ajit Sinha says, good morning. Hi, Ajit. How are you? Chirag Vyas says, good morning, Mark sir and Shailendra sir. Well,
I love the politeness of our viewers. They're very, very kind always for us. We have to admit that. Thank you, guys.
Thank you. Thank you for joining, guys. Really, really appreciate it. Rebecca Buckness says, data quality is essential. Thank you for continuing to emphasize this. Thank you very much, Rebecca.
Yes, garbage in, garbage out.
garbage in, garbage out. We always say that, and that's the truth. And you need to understand the importance, and that's where the digital transformation plays a huge role in the whole thing. Okay, Chirag Vyas says, happy to see Mark smiling today, Mark. You've got
It's the double espresso. I got Neil beans, and they really wake me up at 6 a.m., I can tell you.
good stuff. Avinish Chandra. Hi, Avinish. How are you? He's from DBS. He's a data scientist at DBS Bank. He says the traditional modeling techniques in finance are still being used due to the lack of confidence in more powerful models. Why do you think so? Who wants to go?
I'm going to give that one to Cam because I like to hear what he's saying about that.
And
Yeah,
before Mark.
So I would separate it into regulatory models and non-regulatory models. The non-regulatory models, we do see a pickup of AI techniques or ML base, even though some of them are harder to explain. So a lot of it has to do with the explainability, which means transparency and understanding of the techniques and so forth. So that we're seeing more on the operational and the non-regulatory side first, mostly in the kind of the sales and marketing type use cases that generally are a little bit more flexible and have a little bit more budget and so forth. The credit risk side, most banks are still kind of relying on scorecard based and linear regression type. And I don't foresee they're going to get rid of that anytime soon, because it takes 3 years to get a regulatory model approved. But what's going to happen, and we're doing that now, is that these models are being augmented with ML driven type techniques and models. So it's going to be sitting side by side and kind of add value to it. But the traditional models aren't going to go away anytime for the major banks. But for the fintechs, that's already kind of foregone conclusion.
Yeah.
Mark? I think it's also a matter of habit, right? It is the longer you're in a career, the more you stick to what you know.
Exactly.
It's a very simple example when you are in the US and you want to rent a house and it's from a private person. They want to do a credit check. Do they go to, right? And which one do they go? Do they go to the top 3? Mm-hmm. And we know that even the top 3, when you use one of those consumer credit apps, can have like 20, 40 points of its credit rating different of you, because just how they look to the past, etc. Right? Have they realized that you already have paid off your car loan or not? Do they care about car loans or not? And so you'll see the Experian, the TransUnion, all these players are the top 3 that everybody defaults, because they're the brand name everybody knows. They're also, sadly, in my personal perception, I can't speak for SAP, but I can speak as Mark, 3 of the most conservative, incredible, inflexible models that have been on the market for ages, right? But you get to what you know. That's a little bit the other part. It needs to be market driven, and it needs to be driven by a market that realizes that other models and other suppliers can provide a better, realistic view of what they do. And the moment you know that as a business, of course, you're going to say, like, hey, you want a credit check from me, go to this provider, etc. The second is the revenue models of these companies have also been very traditional and therefore comfortable and solid. Mm-hmm. And credit management or credit score as a service, I mean, it's been, when I was at IBM and even before Watson, we started in 2010, 2011 about, can we supply credit scores as a service at IBM? Can we do this? Because we do this for multiple players. They're crunching it already. And it was really hard. The market wasn't ready for that. Like, everybody says, a great idea, but we're not going to get a empty field in our app that's then being fed by another player. That's not solid. That's not reliable. That's not how we do it. Because, credit risk managers, actuarians, and accountants are not the most, in general, change-embracing professions, to say it nicely. And those things play a role as well. Who makes the models, who makes the techniques, who sells the models, who uses the models. And these are all very change-averse, risk-averse, therefore, trained professionals. With all due respect, by the way. That's
So in my view, this will all change when actual machine learning comes into play, where there will be no human intervention, and the credit scoring will be absolutely automated.
Yeah, no, it's never going to happen, Shelley. There will always be human intervention. Only the human intervention will be on the outliers. So it can be like, hey, the model can't really handle this. Or, hey, the model flagged me like, yeah, this is a little bit outside my confidence score. Dude, you have to now take care of that. That would also be an honorable way to be a credit or a risk manager, right? To use your brain and to have the repetitive numbing task taken away by you by AI and focus on those 10 or 15% of the cases that are duly worthy of your skill, right? Then it gets interesting because, man, if today you have to do that, you have to go to this model, like, oh God, another one, no, that's not right. Oh no, it's like, you stupid dumb model. Of course, that zip code is new in the city. Why don't you know that? Like, I mean, it drives you nuts. But the moment you get the interesting cases, like, oh, Elon Musk is one of the investors here. Oh, so is Bill Gates. Now, I understand why you're outside this model with this company. Like, oh, and this person basically was 21 and graduated from Stanford already and had 2 startups in his pocket. Oh, yeah, no, this is a model. This is an outlier I like to look at, like it's, you need to look at the problems of profession as well.
Okay, quickly, next question. Chirag Vyas says, how AI can work in education fields. Now, I know it's out of the scope for today, but if you want to have a go. Mark?
So there are 3 things in education that works with AI. One is the part actually where we just get supported in our education, like asking questions, finding information, think about research, think about also the concept of balance and bias, right? The things is, I just had a discussion yesterday. I have one phenomenal graduated daughter and 2 teenage boys at home. And with teenage boys, people say, oh, it's so much easier. They just cut and paste things from the internet. I'm like, you don't get it. This is harder than ever. I used to go to the library and I picked 3 books and had 3 quotes, and it was pretty solid. But now even everybody can just edit a Wikipedia, and for an hour it can be totally off. So their balancing of like, is this information solid? Who's the source? Who's been the author? What is the data tracking point, etc.? They need to be much more balanced already just by finding information. Think about how you ask a question in a search engine like Google. Depending on the word order, you would get a different, depending of the location. I mean, The Social Dilemma on Netflix is a really good documentary about how we need to start critical thinking and how algorithms are geared to give us more of the answers we're looking for and putting us in a bubble. And so in education, getting some unbiased or some clearer, balanced information gathering is where AI definitely is coming to the rescue. Now, the second is basically, but especially when you do stuff, right? Think of Grammarly or Hemingway, how it helps you to figure out as a non-native speaker how your English is not on par or too complex in construct or could be shorter. Think about in physics or in math how actually on iPads and Android tablets, instead of typing all the formulas in, you can just handwrite it, including square root signs, etc., and it helps you to balance your formulas, like a dynamic whiteboard. All these tools take repetitive numbing tasks away, but they also free up productivity. So education is changing both in the preparation as in the delivery, as in the tool support at this moment.
Okay, good stuff. Hopefully, Chirag, you got the answer to your question. If you did, then please share this episode with others so that people can learn from this particular episode. Okay, very quickly to next question. Chirag says, gratitude to all of you. Thank you, Chirag. This is a smiley from, and I know who that is because I'm going on LinkedIn to see who that was, by the way. It's Marlon De Cruz, and Marlon De Cruz says, smile. I don't know why the name didn't appear, but that was Marlon De Cruz. Okay, next question or a comment is from Avinish Chandra again from DBS. He says, the credit assessment problem is something which I've faced myself. Do you think it is something done diligently for more profit margins? Ken, can you?
I mean, it's all at the end of the day. Yeah, I mean, it's going to be about the P&L. It's about provisions, about reducing kind of loan loss. But what we're also kind of seeing is also driving to become a profit center by looking at revenue opportunities. And I'll give you one example, which is something actually we're working on this with SAP. So if you look at the entire kind of supply chain life cycle of a supplier and one of your customers, let's take a telco, which is let's say that's one of your customers, and they buy from a cable manufacturer, and it's a 250-day cycle time from a purchase order all the way through to a payment. In traditional invoice financing, you're just looking at covering the payment cycle, which is typically 45 days. But what about the other 210 days or 220 days of working capital cycle? So how is the supplier going to get money to build to procure all the equipment, the supply equipment, to manufacture these cables and ship it to the telco? And that's really where PO and pre-shipment type financing come into play. But the problem with assessing that risk is very difficult. Traditionally you go and to inspect the factory, to meet with the supplier. What if you can use the data that's available in SAP Ariba to predict a lot of these type of risk parameters? And that's a huge revenue opportunity for the financial institution in order to finance earlier part of that supply chain. So that's kind of one of the what we call SCF 2.0 that we're embarking on to enhance more of a profit center than just just mitigating risks.
Mark, you want to add something to it, or should I move on?
I think Ken was spot on. I think credit-adjusted profitability forecasting is really where the more advanced are going at the moment.
Okay. Next comment is from Marvin. Hi, Marvin. How are you? Marvin is from our SAP Labs. SAP Innovation Center. And he says, great to hear from Mark and Ken on the topic. Good stuff, Marvin. Sally Lingworth, one of my good friends, says, hey, Shelly. Hi, Sally. How are you? And she's got a question. And her question is, do Australian regulations support the solution, and we can therefore expect to see a product launched here?
Yeah, that's going to Ken.
To me, we don't play in Australia, so I'm not quite sure. But for us, our plan currently is to grow in the US, and then the next place is going to be in Europe, where we have some of the backings from ING and others, where allow us to kind of roll out in that market. But potentially in Australia in the future.
Okay. Agus Laksono says great. Thank you, Agus. Get to the next question. This is for you, Mark, from Annie. Hi, Annie. How are you? And she says, hey, Mark, what trends are you seeing with enterprises in the past few months? Has the appetite and adoption for Industry 4.0 increased, or there is still a knowledge gap? Has COVID accelerated interest?
Yes and no. I said before, the Nile is not only a river in Egypt. And what we see is that there are two kinds of companies. Those that understand how to extrapolate data. You get one, and the other ones. And the point is, what we see is that there are companies at the moment that are realizing that connecting their data sources, getting adoption, especially manufacturing of Industry 4.0, is something that can create them not just agility, but a lasting resilience for a next wave of COVID or for the next big thing to come. And there are those that scrambling and struggling to survive, or just not in the mindset, or are afraid for the complexity of change. So COVID has brought us closer, most companies closer to dealing with operational issues, and lesser companies are able or being listened to the more strategic, impacting things they should be doing, sadly. Like every kind of economic or supply chain intervention, we will see winners and losers the coming year.
Okay. Next comment is from Subhashish Ghosh. Hi, Subhashish. Says good morning. Good morning, Subhashish. Ravindra Khambar he says hi. SAP AI manufacturing industry.
Yes.
And yes, there is one. And so, guys, please send me a message and I will get you to the right direction. Avinish Chandra again asking a question. Don't you think whatever models we try to use in BFSI, they actually tend to expose these discriminatory characteristics, either singularly or in combination of multiple features, which are then in turn used to decision making, not necessarily specific features like gender, race, etc., etc.
Yeah, I mean, I think there's obviously way more we can continue to do here. Explainability. There's a lot of research and development that's been going on in explainability to make these these models much more transparent. There's also a lot of new startups that we've seen in the past 2, 3, 4 years that have came up in the forefront to try to solve for this. We shouldn't kind of let that to stop adoption and innovation that's happening with ML and AI in general. So, but I think there's always going to be that tug of war between driving further and further on innovations and also kind of being compliant and fair on and protecting the consumer down the road. Yeah.
Okay. Next comment is from Shubham Sahai. Hi Shubham, how are you? He says, AI is definitely a competitive advantage now. What do you think about its adoption? I think we've been talking about this for a long time, but anyone wants to add a comment or two? Or happy to move on?
Ken, do you want? I know we'll do this, so I think it's fun to have our guest actually give this his perspective.
Yeah. So I mean, on the one hand, you have speaking about corporates, I mean, you see a lot of corporates adopting innovations lab and having a ventures arm, adding these startups, partnerships, and so forth. What's sort of missing, I think, is the notion of understanding that a lot of times AI is very probabilistic and not like traditional software, which is very deterministic, which means that you need to have the mindset of lots of experiments, running lots and lots of experiments, and kind of seeing what works, what doesn't work, and have that mentality of testing things and trying out different things, as opposed to the waterfall type software type mentality. And I know it's not just running experiment. Experiment has a lot of kind of costs around it. Project management and change in all the transformation that's required. But if you can adopt a way of doing these short experiments, I think that's sort of kind of one barrier that I see, as opposed to allocating a huge budget for one big project, and that's going to be tough to get these sort of things to fly until the executive sees that there's a true ROI here, and some of that is going to be tough to quantify until you actually see it working.
Mm-hmm. Good stuff. Next comment, Avnish Chandra says, awesome watch, Social Dilemma.
Yes.
Yeah, it's great.
Don't watch it just before you go to sleep.
Or after using Facebook or Google.
Yeah.
Okay, guys. Avnish Chandra says, thank you for insights, Mark and Ken. And this question was very interesting. Senthil Kumaran. Hi, Senthil. How are you? He says, how does RPA help in auto-resolution in user-created incident using service now? So as we two, me and Mark, have been auto-resoluted or not, as we say, in this particular episode. What do you think, Mark? What could be done?
Well, I mean, intelligent robotic process automation and not rule-based robotic process automation follows exactly the principles of AI training, right? It needs to have examples of how the problem has been resolved. If not, it needs to push it back and says, don't have enough confidence. So this is all a matter of, have you had cases before that the RPA machine learning can learn from or not? And what we try to do is sometimes give a best of 4, best of 5, say, can't resolve it, but these are some closest option that I see, pick one, and then we learn from. So that's the summary short I can give.
Good stuff. And finally, a question from Senthil. Hi, Senthil, and he says, do we have any comparisons of Blue Prism like with SAP RPA? I've got no idea.
I'm sorry.
Okay.
I'm sorry. I hate to admit I don't know anything, but this is one of those.
Good stuff. Okay, guys. Thank you very much for the questions. So those were the questions. Now, finally, before you guys leave us, I've got one phrase from both of you, which you want to say to the audience. And anything about AI, financial services, SMEs together, what do you want to say? One phrase, could be a paragraph or could be a sentence maximum, not a paragraph. Ken?
So, I think obviously we're certainly living in unprecedented times, but, kind of finding that, golden nugget, and, you could kind of view this time as the best of time. And as Andy Grove, the founder of Intel, said, bad companies are destroyed by a crisis. Good companies, or survive a crisis, but it's the great companies that are defined by the crisis. So how do you, think about how you become in that last bucket is going to be key. But I would think could be an opportunity for a lot of companies.
Mm-hmm. Mark?
I think that and without being shamelessly self-promoting, I did this TED talk last year about the 500-hour job, about how we have the ability to shape our society and balance purpose and work together. The biggest issue is that we're still on a paradigm on a 40-hour job contract based on Tayloristic thing. And in the last 3,000-4,000 years, we never defined work except for output. And suddenly we started measuring professionals, experts, educated individuals, knowledge workers, based on a 40-hour presence in a company instead of the output that they generate. And therefore, most of us are doing mind-numbing, repetitive, dumb tasks, or are Googling around the internet or watching Netflix just to fill their 40 hours. Now, that's a little bit blunt to say. The reality is that AI is, or the impact of more flexible technologies such as machine learning is already having a profound effect on the last non-automated part of the world, professionals, knowledge workers, experts. And that means we have an opportunity to reshape and redefine society as we want it to be, but it also means we need to let go of some older paradigm principles. It doesn't matter if it's like, should I be measured on 40 hours? Because most professionals don't work 40 hours. They balance their week and they balance their purpose and they're doing other things, but they get their job done. Should I take the old traditional models to do credit scoring, or will I actually be more dynamic, more forward-looking, etc., right? As Ken is doing, is another paradigm shift. So we're going to get a serious amount of paradigm shifts, and we will end up in the society that we create, or by looking the other way, not create. So this is a cusp moment. I think 2020 has been a cusp year for many things, pandemic, geopolitical, but also for the AI technology is now really embraced. And there's a reason I come up with social dilemma or refer to that TED speech, because we have, as a society and as governments, different directions to go. And I again, Ken, I applaud the work you're doing with your company to bring some sanity into the world and not follow the tradition. You could have chosen to let's take the existing credit models and let's make it faster, quicker, and cheaper, right? You've chosen another route, which is innovative and challenging the old paradigm of thinking, and we need to get more of this kind. That's also why we do the show, right, Shelley? To show people that there are, in the words of Picard, there are other ways.
Good stuff. Thank you, guys. Thank you for your time. It was a pleasure having you both on the show. Thank you, Ken. Thank you for your time. And I know
Appreciate
it's
it.
now going to be midnight for you.
No, it's a lot of fun.
And this was really fun. Really appreciate being there together.
Yeah,
Good
fine.
stuff. Thank you, guys.
Thank you so much.
Thank you. I'll see you later.
Thank you.
So, guys, that was Ken from Flowcast and Marc Teerlink from SAP. Hope you enjoyed the episode and you liked various comments that were thrown out there, and you understood, you got some more knowledge out of this particular episode of AI Startup Insight series. And if you did, then please, if you're watching this on LinkedIn, please press the follow button. If you're watching this on YouTube, please press the subscribe button and smash the bell icon. And if you're watching this on Facebook, then please like this episode and also share it with various groups that you are subscribed to, so that more and more people can learn from this episode. So thank you very much for your time, guys. All those who are watching this episode live or are going to watch this on replay, thank you very much for your time and hope you learned a thing or two. Thank you, and I'll see you next week. See you soon. Bye now.